The China Securities Regulatory Commission has a new chairman over the last couple months, and that historically tends to mark a bottom. Should we believe it this time?
No, I think eventually the answer will be yes. My concern right now is that while we've had a pickup in manufacturing activity, which is really a global phenomenon, by the way, you saw that in the U.S. as well this week, the problem is the domestic economy really relies on credit growth. And total social financing, the TSF number that we all watch when we think about China, it's actually down 12% for the combined January and February months, which takes out the effect of their new year. And that's a problem because that's the lowest reading since 2012. So the stocks have bounced back on rumors of policy support, but we actually haven't seen any fiscal support thus far. So I think this rally will have to go back to the bottom of January, and then I think you will have a great entry point later this year in Chinese equities.
You mentioned the comparison in manufacturing growing both in the U.S. and China. I wonder about the credit versus capacity comparison as well. I mean, we're seeing more and more consumers in the U.S. use more and more credit. That's spending beyond their means. Is that a concern in China as well?
Yeah, it is, because they've been doing it for 10 years. You see, so this is a very important point. And I mean, you nail it right there. In the U.S., we've had 10 years of deleveraging. So the private sector, by 2020, was pretty much done with about a decade of deleveraging. So your point that they're taking on credit, that's true, but it's not yet in a dangerous territory because in the U.S., we've been only doing it for about 4 years. And on top of that, U.S. households got that $3 trillion worth of stimulus, 2020, 2021. In China, they are where we were 10 years ago. And so they're in that decade of deleveraging. And that's why we're constantly being disappointed by their credit data. And that's why I think it's very difficult to invest in anything in China that depends on domestic economy. Now, externally focused companies, Chinese companies that are selling abroad, they're benefiting from American consumption and European recovery. And that can be an investment strategy, I think, for the remainder of this year and into next year.
Well, what's the strategy? What's the sense in investing in an externally focused Chinese company versus investing in the market that company tends to focus on?
Well, you know, it's like, for example, the situation in Germany. Right now, the DAX is at all-time highs, the German equity market, even though German economy is effectively in a recession. And so if you have externally oriented equities and indices, they can do well even if the domestic economy is suffering. So in China's case, there will be a lot of EV manufacturers, battery supply chain, alternative energy companies. They should do well anyways. Plus, because of the situation at home, the currency renminbi is quite weak, which makes those companies quite competitive. Of course, there's tariff pressures, there's politics, there's nationalism, protectionism. Those are all big long-term risks. But for the next 6 to 18 months, these companies can do very well. However, for most investors listening to this, you know, this is way too detailed of an investment strategy. I would just say, look, the bottom line here is that domestic credit is not confirming a rebound in China. And on top of that, the government is imposing austerity, kind of like we did in 2010, 2011, when the Tea Party came to power. You know, same things are happening in China. They're actually trying to narrow their budget deficit at the same time the private sector is deleveraging. So if you're just trying to buy Chinese equities, I would punt on this tactical rally, and I would wait for policymakers to commit much bigger support for the real economy.